Hello, everyone, and welcome to our monthly investors seminar. We are XpatHomes, a professional and experienced real estate company. We are thrilled to be here today to introduce our company, explain what we do, and show you how we can help you grow your portfolio. At XpatHomes, our primary mission is building and furthering Japan's strong business relationship with the USA. We operate directly from the United States. To support the success of Japanese people and Japanese companies, we achieve this by improving the living and work environments of their homes and offices, and by establishing a strong local living infrastructure for them. So, what does this mean for you as an investor? We specialize in a unique leased home creation model. We create lease homes specifically designed for expatriate families arriving from Japan, which creates exclusive investment opportunities for professionals looking to build passive income and capital gains. We pride ourselves on being a one-stop real estate service. If you are considering American real estate investment, we provide comprehensive support, specifically tailored for real estate investment in rental properties for expatriates. One of the reasons our investment properties are so successful is the unparalleled support we offer. Our tenants, which keeps vacancy rates low. For those looking for rental housing in the United States, we provide local portal sites in Japanese. These portals help those moving to the area by providing rental house listings. Alongside crucial local information, such as schools, restaurants, and activities, we also offer dedicated corporate support and expat support to ensure a seamless transition for the families living in our properties. Let's talk about where we operate. We currently have physical offices in Ohio and Alabama. Through our strategic partnerships, we have aggressively expanded our service areas to offer investment opportunities across multiple states, including Ohio, Alabama, Indiana, Michigan, Kentucky, Kansas, Missouri, Tennessee, and North Carolina. We are not stopping there. XpatHomes continues to work on the nationwide expansion of our services, which includes the exciting development of a Japantown in the Columbus region. We would love to help you take the next step in your investment journey. Please feel free to contact us with any consultations or questions you have regarding real estate investment. You can reach our main office located in Dublin, Ohio. Thank you all so much for your time today. We look forward to partnering with you and answering any questions you may have.
Okay, so my name is Eric Smith. I'm with First Community Mortgage, and I'm a mortgage lender specializing in investment property purchases and refinancing. And today I just want to go over a couple market trends. We'll start off with some market trends. The hot topic is where are interest rates? Where are they going? So I'm going to share a couple slides on where they currently stand and what's anticipated for the rest of 2026. And then going to dive into how to utilize the equity. Right now, property owners are sitting at record levels of equity in their properties, and so I'd like to discuss and present how to tap into that equity so investors can utilize that to expand their portfolios by acquiring more properties using the equity in their existing properties. So on the first slide, where are interest rates headed? So I have a snippet here, and this is from the Federal Reserve. And contrary to popular belief, the Federal Reserve does not set mortgage rates. So the mortgage rates are actually determined by mortgage-backed securities. Those are bonds that are traded in the bond market. Those ultimately determine where mortgage rates currently are and where they're headed. However, the Federal Reserve, they kind of set the environment, the precedent, or the overall environment of what the bond market does. So we often get asked, or I often get asked, hey, the Federal Reserve dropped rates a quarter point. Does that mean mortgage rates dropped a quarter point? And that does not. The Federal Reserve adjusts the federal funds rate, and that's actually a rate that banks borrow from the Federal Reserve. So for 2026, this first paragraph here, the Federal Reserve, based on their most recent meeting, they're projecting a one-time cut sometime in 2026 of 25 basis points. That's a 1/4%. And so what that means is that the Federal Reserve is expected to lower the federal funds rate by a 1/4% sometime this year. Now, that can change based on economic variables. Um, Obviously, we all would like to see rates drop further than that, but based on current economic indicators, the Federal Reserve anticipates lowering rates by a 1/4%. Now, the second paragraph here about the market pricing, bond futures are pricing in 2 rate cuts. So what does that mean? Well, what that means is that where bonds are traded, mortgage bonds, they're anticipating 2 rate cuts this year. So if the Federal Reserve doesn't cut rate two times this year, that can cause the mortgage rates to actually go up because the bond market is 6 months forward looking. So any potential rate cuts up to 2, as that second paragraph states, that's already priced into where current mortgage rates are. So if there's any deviation from that, if they cut it one time, we could see rates go up. If the Federal Reserve cuts rates more than 2 times, more than what the bond market is anticipating, we could actually see mortgage rates decrease. And hopefully that's the case in 2026. So let's take a look at where rates have gone over the last year. So this chart here, now this is for primary mortgages. For the investors out there, the interest rates on investment properties are normally 0.5% to 1% higher than a primary mortgage interest rate. So as we can see, the blue line, that reflects a 30-year fixed mortgage. And from March of 24 to where we could see in February, we could see that we've had a pretty good trajectory downward here, currently sitting at 5.98%. And then the green line, that is a 15-year fixed rate mortgage. And we could see that that has also come down as well over the last year. So it's good news. We're headed in the right direction. Again, both Fannie Mae and Freddie Mac, those are the 2 big conventional housing agencies in the United States that insure or back the majority of mortgages. They anticipate rates to remain pretty flat. Again, they're going based on what the Fed expects to do with the Fed funds rate with 1 rate cut this year. So they expect the mortgage rates to kind of flatten off, plateau, and remain here through the end of 2026. The good news is the downturn or the decrease in interest rates over the last 12 months has made affordability more attainable for more homeowners. Just in the last month, just in the dip in rates over the last month, they think that 500,000 new homeowners have entered the pool. And that's because that interest rate has made it more affordable for their monthly payment. So we are seeing some good movement there, though it's not expected to decrease much for the rest of this year. Next year, they're anticipating much larger rate decreases. So let's take a look at home equity. So as I stated at the beginning of this, we wanted to dive into utilizing the home equity that most homeowners have, and especially investors, to utilize that to buy additional properties. So just a couple market notes here or trends. So in 2010, the home equity in the United States was 8.97 trillion. And in a 15-year period, that grew to a record 35.8 trillion in Q2 of last year. So that's a sizable jump. And much of that was spurred on during the COVID pandemic. Rates were at record lows. Home buying, was a frenzy, and that pushed home prices and home values to record highs. So currently, a couple bullet points here. 44.6% of mortgage properties in the U.S. Had at least 50% equity. So that's a record as well. So that tells you there's a tremendous amount of equity in properties right now. And the average mortgage holding homeowner holds anywhere from 299,000 to $302,000 of equity, which again is a record, and that is anticipated to grow with home appreciation in 2026 anywhere from 1 to 4% on a national average. Some markets will see higher growth, and some may see lesser growth, but that home equity is expected to continue to rise. So, as an investor, let's talk about what we can do with that home equity and ways to tap into that home equity. So, right now, I've listed a couple items here that the home equity or tapping into that home equity that can be used for investors. So, you can tap into it for down payment on the next property you want to buy. And I did put in parentheses minimum 20%. That's just a side note. Usually, when you buy an investment property, the general down payment requirement is going to be 20% down of the purchase price, and then you'll have closing costs on top of that. Now, the more money you put down, the lower your interest rate is, and obviously the lower amount that you're financing. So in those two in conjunction with one another, we can help reach that cash flow that you're looking for. Tapping into the equity can be used to pay closing costs, or if you have enough equity, a lot of investors will sometimes extract the maximum amount out and just pay cash for the next investment property. That's become very commonplace here in recent years, and gives you a little more leverage when you're making an offer on a home if you're going to be a full cash buyer. Or you can combine with existing assets you have. So, for example, let's say you have $200,000 of equity in your home, and you have $100,000 of cash that you have in your bank account, and you were planning on using that to purchase your next property. You now have the 200,000 plus your 100,000. You now have 300,000 to put towards the next property. A lot of times I recommend to clients, if you're going to continue to build your portfolio, I would sometimes shy away of just liquidating all of your equity and just and using it all at one time to buy one property. Usually you take that equity, you use enough to put down payment and closing costs on the next property, and you still retain some of that equity to buy a property, subsequent property or subsequent properties, right? So instead of using all at one time, just use what you need to acquire the next property, and then the property after that, and so on and so forth. And there's a lot of benefits to using the equity in your home. One is the obvious is retain the cash that you have. If you have funds, like I mentioned, in checking and savings, and you'd like to save that and just use the equity, that allows you that ability. Tax avoidance. So if you have money that assets that may be invested, mutual funds, stocks, bonds, etc., you may have a taxable event if you need to liquidate those to purchase another investment property or any property. Well, by tapping into the equity, since equity is a debt instrument, there's no taxes on that. So it shields you from that tax liability. One of the greatest things about tapping into equity. And it can be quick and cost effective. So on the next screen, we'll talk about some of the avenues on how to tap into this equity. But a couple of them you can, or really all of them, you can put into place if you know in the near future or down the road that you plan on purchasing some additional properties. You can go ahead and get that access to the equity done early on. So this way, when you see an opportunity, you're able to move on that in quick fashion and already have access to the equity. All right, so question that I often get, how do I access and extract the equity in my property? And that's a really good question, because there are multiple ways to do that. And there's no one better way than the other. It's really going to be dependent upon what your time frame is, which you are best suited for, and what you're most comfortable with. All of them can accomplish the same thing. They just work a little bit differently. So one is a cash out refinance. That one, that term is very popular in the industry, and that a couple components of that. That's a fixed rate, and then you choose a loan term 5 to 30 years. So the way that would work, if you own a property free and clear, and no mortgage lien on it, you can take the equity out as a fixed rate mortgage. It's called a cash out refinance, and you can choose a loan term from anywhere 5 to 30 years. So that's going to have a fixed term with a fixed rate with a fixed payment amortized over that 5 to 30 years. Now, cash out refinance in this market, if you have a first mortgage, depending on the interest rate on that first mortgage, this may not be the best option for you. So, for example, I have a mortgage that I took out in 2021, 2.625%. Rates today are around 6 to 7%. If I were to do a cash out refinance to tap into the equity on my home, I would have to pay off that first mortgage with that cash out refinance, and that would be at current market rates. And certainly you don't want to take a low interest rate and double it or increase it at all. So the cash out refinance would really be tailored to those folks that if you own your property free and clear, no first mortgage, or if the interest rate on that cash out refinance loan, because we have to pay off any first mortgage that you have, as long as it's in the same ballpark or less than the mortgage rate you have on your first mortgage. And so that's why we'll look at two of the other options. If you are in a situation where you do have a first mortgage and it's at an interest rate that's lower than today's market rate, we'll look at options on how to tap into that equity. So option 2 is a fixed rate home equity loan. So just like a standard mortgage, a fixed rate home equity loan is very, very similar. You get a lump sum of money and you're going to choose a term. Normally, those are 10 to 30-year terms. Normally, you can choose in 5-year increments, and it's a fixed rate with a fixed payment. And it's a one-time lump sum, just like the cash out refinance. If you were to do that as well, or either one of these, you get a lump sum at closing of the cash proceeds, and then you choose when and how to use that lump sum cash proceeds. And then your monthly payment will be based on your loan term that you choose, as well as the interest rate and the amount that you're borrowing. And the final option, which has become very popular, is the home equity line of credit. So home equity line of credit is exactly as it sounds. It is a line of credit. So for example, if you have $200,000 equity, and you get a line of credit for a percentage of that, normally 70 to 80% of the equity you have available in your home is the line of credit amount you can get. And you only pay interest on what you borrow. So for example, if I take out a $200,000 equity line of credit today and I don't utilize that for a year, I don't pay any interest. Okay, I haven't used it. Let's say I use 25,000 of it to purchase a property, then I only pay interest on the 25,000. I still have the other 175,000 available for future use. So 6 months from now, a year from now, 2 years from now, I want to buy another property. I have that available equity credit line that I can tap into and purchase more properties. And again, I am only paying interest on the money that is outstanding at that time. The nice thing about a line of credit is as you pay it down, it frees up that equity again. So you can continuously repeat, borrow, pay it down, borrow, pay it down. And I'm only paying interest on my outstanding balance at any given time. The nice flexibility with home equity lines of credit is the payments are interest only. So unlike the first two options, which is a fixed term with a fixed rate over a fixed number of years, so your payment remains the same, the home equity line of credit, usually for the first 5 or 10 years, they call that a draw period. And any outstanding balance during that time is interest only. Now, you can certainly pay more or pay it off at any time without any penalty. But while you have an outstanding balance, you're only required to make the monthly interest payments. And again, that interest is going to be based on your outstanding balance and whatever interest rate you're at. The other key difference with a home equity line of credit is that interest rate is variable. So at the beginning of this call or presentation, I mentioned that the Federal Reserve sets a Fed funds rate. Another index that they control is the federal prime rate. So most home equity lines of credit are tied to the federal prime rate. So what that means is, unlike a mortgage loan where the Fed adjusts rates, that doesn't have a direct impact on mortgage rates. However, on a home equity line of credit that's tied to prime, if the Federal Reserve lowers rates by 0.25%, that home equity line of credit will interest rate will lower by 0.25%. If they lower by 0.5%, then your home equity line of credit interest rate will decrease by 0.5%. And conversely, if the Federal Reserve increases rates by 0.25% or 0.5%, then you'll see that home equity line of credit interest rate increase by 0.25 or 0.5%. And that change in interest rate is going to be applicable to any outstanding balance you have at that current time, and any future uses or draws that you take on that home equity line of credit. So there are some key differences. And again, it's going to boil down to what you're most comfortable with and what your long-term and immediate goals are. And it's different for everybody. So the nice thing is these three options are available on just about all types of investment properties. So whether you have a condo, you have a single family or multifamily up to 4 units, these options are available. And then if you have any multifamily over 5 units, then you start getting into the commercial lending space, and there are very similar options available for those of you that have multifamily above 5 units and above to be able to tap into the equity. Again, as I recommend to anybody that I talk to, it's important to have a conversation, talk to your financial professional, your loan officer. My contact information is here if you have a scenario and would like to discuss what options are available to you, and what may be the best path based on what your immediate and long-term goals are. I will say in finishing here that the landscape of finance and lending is always changing. Guidelines change on a month-to-month basis, or so it seems, and certainly year to year they change. So what may have held true in the past may be different today, and that may be different a month or 6 months from now. Not that the products will go away, but just some of the requirements and qualifying for these. That is what we see change more often than not. But the good news is in recent times over the last year and a half, the guidelines have actually eased. And what I mean by that is lenders aren't looking just at your income and your credit score. There are other ways to qualify for these lending products, and cash flow of the property, loan to value of the property, and some other things. So if you have any questions, please reach out. My contact information is there, and I hope you have a great day. Thank you very much.